Okay, a warm welcome to Lugano. What we are going to do is, we have about 20 minutes. I'm going to draw upon my practitioner co-author. He'll join us in a few minutes, and it'll follow exactly what Professor Jenkinson was saying. So what we are going to give you a flavor of is based on my joint work with Rick DiMasio, who's here, and Anton Lyons is a PhD student of mine from South Africa at the London Business School. So the kind of questions we are asking is the following. I should have put Roger Federer's picture out there. Are they really world apart? But we thought, coming from England, let's have the... both are superstars in their own right, highly rewarded, high achievers, and their fans believe that they are highly skillful. Yeah? Wayne Rooney's manager has every statistic on him in terms of passes, in terms of defense, shot, own goals, whatever, when he's playing offensive, defensive, everything. And that's true for Roger Federer, when he's playing backhand versus forehand, aces versus double faults versus drop volleys versus any game that you see, the successful players' actions are analyzed, decisions are analyzed in slow motion, in statistics. Basketball has it, baseball has it, cricket has it. So in Warren Buffett's case, or fund managers' case in general, people speculate on the sources of his success. It hasn't been possible to put him under a microscope exactly, although Warren Buffett is an exception because the kind of decisions he makes are about 20 to 30 a year in terms of buying, selling decisions, while a fund manager may be doing much, much more. But reality is that we really don't know enough about fund managers, like successful ones, as to Warren Buffett, as to how he does what he does. Okay? But that is changing, thanks to my co-author here. We look at it as Warren Buffett and Rooney don't do the same thing, but both make decisions. Buffett decides on buying and selling, or what not to buy, what not to touch, while Rooney decides whether to shoot or to pass or to do something else. Both are observable and measurable if you have the data. And we are, with Rick DiMasio and Anton Lyons, we are literally analyzing hundreds and thousands of individual investment decisions. And consequently, we can have a much better idea of what skill constitutes skill. So at this point, let me invite Rick to take us through what he's been doing. Not me. What he's been doing over the last 15 years in terms of gathering data. And it also follows Professor Tim Jenkinson's presentation. So please.
OK. Thank you, Narayan. So essentially, our business analyzes every single investment decision that fund managers take. That's every purchase, every sale, everything that they own, and everything that they don't own. And we've been collecting this data now for about close to 8 years. And believe it or not, we have a database of 100 million separate investment decisions, which makes it one of the largest, if not the largest, in the world of this type of activity. And the data comes from all over the world. We have clients in Australia, South Africa, across Europe, UK, obviously, and the States. And we built up, it's about a portfolio, it's a list of close now to 1,000 separate portfolios. And in terms of what the data is used for, ultimately, as Narayan said, one of the primary purposes is to provide feedback to our fund management clients, of which there are 2 in the audience. I understand there's a representative from Schroders and from UBS in the audience, and many other asset managers, and to provide them with the feedback in terms of what they're getting right, where the patterns of success and failure are, and how to improve their game. The other side of it is that we're also used by asset owners when they're selecting and monitoring their existing managers. Now, what's quite coincidental about this is that in recent months, we have had a new group of clients, one that we hadn't had before. And I know that this conference is largely academic, and there's the factors of cause and effect, but I won't address that in the sense that following Tim's paper, which I personally believe is probably one of the most important papers in finance of a long while. Not that I read them all, so I can't make a judgment, but certainly in terms of its impact and its clarity, and certainly clarity, but also impact on the industry, is really one of the most important that I think there's been. But also I can say that because it may well have been important to us, because in recent months, Towers Watson, Barnett Waddington, and a firm in South Africa, Alexander Forbes, are also now using our data to analyze the managers as a part of their research program. And really, essentially, what this is about is the fact that in our industry, our industry has grown up on the basis of, trust me, I'm a fund manager, I have skill, and therefore you should give me the money. I think that actually the world is changing, and that it's now moving in the same way as the rest of other industries operate, on the basis of provide some proof statements. Demonstrate that as a fund manager you do what you say you do, and that is what you're good at. And I think that for me, fund management, and now this is, believe it or not, my 35th year in this industry. I started in 1979. And that what I see is an industry very much at a stage of change, but coming from infancy. And the role of evidence and analysis is going to become much, much more important. And whether it's Tim's paper and his colleagues that have brought this about, but I think that basically what's going to happen now is that the disciplines which are applied to other industries, such as to be able to provide proof statements and to be able to demonstrate that you do what you say you do, and that you're using information and evidence intelligently to improve your game in the same way as other industries operate, then I think that for me, what I see in terms of a change, I see that now moving to a new era. And I think that Tim's paper has been very instrumental in that process. So what I'm going to do now is I'm going to hand back to Narayan, who's going to be talking about the research, because the final group, the final purpose of this data, and the reason why I suppose I'm here today, is that we've made it available to Narayan, and we're now going to start a program of primary research into the nature of investment skill. And the first paper has been put together and was presented yesterday, but this is going to be the first of a series of papers on the nature of skill. And I don't think I would say that eventually it'll have the impact of Tim's, but we're certainly going to, we know what to achieve. Cheers, thank you very much, and I'll hand back to Narayan.
Thank you, Red. Okay, thank you. So the data we have is long-only traditional active managers trying to outperform a client-specified benchmark. So client may say MSCI World, or FTSE 100, or Eurotop 350, or ASX 330, whatever that is. And the manager is trying to, in a risk-controlled manner, outperform the client-specified benchmark. So they are explicitly specified by the clients. And the alpha or value added is estimated relative to the client-specified benchmark, as well as the pharma, French, Carhart, academic model one. For some part of the analysis, the benchmark makes a difference. For others, it will have less of an impact, and I'll kind of indicate to you as I go along. And what we have is the daily data on holdings. So every stock held by and not held by a manager. Every trade made, and if it's an order which is split into individual trades, we know how to link it, and those kinds of. So literally, everything that is done by the manager is available to us. And we analyze for this particular part over 1 million trades of buys and sell decisions, totaling to about $1.8 trillion of dollar value of trade. So that's what is our first attempt to analyze and we'll take you through that. So these portfolios, as Rick was saying, there are 67 based on US with different indexes of US, UK 105, Europe 94, Japan 37, Asia Pacific, Australia, South Africa, emerging markets, etc., and the world. So it's not like a particular region or a particular type. It's equities, but worldwide with very different value benchmark, growth benchmarks, MSCI World, cap weighted, etc. So this is partly a topic for this afternoon, but something that is very close to my heart is about the issue of delegated portfolio management, which is a glorified way of saying I'm asking somebody else to manage the money for us. Okay? So, and whenever you ask somebody else to do something for you, there's always agency problem. Those of you who have hired a building contractor in the house or a plumber in the house will know that it's a headache because there are two things that come up. One is a conflict of interest, and other is potential misuse of discretion. And it happens in fund management, it happens in companies. We have shareholders, we have top management, and we need to make sure that these are addressed through incentives or through monitoring. So if you're going to go into equities, there are two ways: passive direct tracking. So you go to Vanguard or SSGA or Wells Fargo or some legal and general kind of things. There's little to worry about apart from tracking error and fees. But if you decide to go down the active route, saying that, oh, markets are not fully efficient, manager can add value after fees and transactions costs, etc., the fool's gold exists, or maybe some people are good at it, whatever that may be, then there are two ways of doing it. One is a traditional active, which is the long-only active managers who outperform or underperform overweight or underweight some of the stocks in the benchmark. Or you can go the hedge fund way, which is the equity long short, equity market neutral, or that kind of thing. The hedge fund model and the mutual fund model addresses the agency problems very differently. That's a discussion for another day. But we have looking at, our talk is about traditional long-only active, where we can see their positions and we know whether they are overweight Vodafone, underweight Glaxo, overweight Marks & Spencer, underweight something else. So we see that on a day-to-day basis, and whether their overweight becomes even more overweight or underweight becomes even more underweight, and when do they balance. So all of that is available to us. They're continuously monitored. These are all segregated managed accounts. They're not pooled funds, so there is no need for window dressing or any games to play around disclosure time because it's seen and monitored on a daily basis available. And the managers, the only way they can add value is go overweight, deviate from the benchmark, take on active risk. Okay? So that's what it is. So the way we think about active risk is the green bars there in 10 stocks are the weights of the portfolio, and the blue ones or the aquamarine ones are the ones which are the benchmark. So on the right-hand side is measuring how your holdings differ from the benchmark. So you're overweight in stock 1, stock 2, stock 3, stock 4, stock 5 with a different magnitude. And then you're underweight the other 5 stocks. In this simple example to say, what is active risk? That is what the manager is taking by deviating from the benchmark. Clearly, the manager is very bullish about stock 1 because he's heavily overweight, and very bearish about stock 2, he's heavily underweight. He'll still be holding stock 2, but less compared to what the benchmark does. And there are some stocks he may not hold at all, partly because of transactions costs or too small a stock to kind of dedicate efforts, or is bearish, so bearish that he doesn't want to touch it, he or she. This is lots of numbers, but just to give you an idea, we have stocks, we have trades that are completed within 1 month, 1 to 3 months, 3 to 6 months, 6 to 12 months. So we know short horizon trading versus medium horizon trading versus long horizon trading. We know buys, we know sells, what is the trade size, and so it's just to give you an idea. There are about 600,000 buy trades we are analyzing, about 700 sell trades, over $1 trillion of buy, and about 732 billion of sales. So it's a big database. It's comprehensive. So I don't want you to remember all these numbers. Just saying that it is comprehensive. It's not a small sample bias, and it runs over 11 years, 12 years. So we have the bull market of 2003 till 2007. And then we have the bear market with high volatility up to March 2009. And then you have the sideways market with medium volatility. So we have seen them in pretty much very different market conditions making these decisions. So it's not that we are kind of restricted in terms of this. Okay, so the simplest thing that we do is called the hit rate. Hit rate is saying what percentage of their decisions outperform the benchmark. So if they were to buy Vodafone, did Vodafone outperform the benchmark? If they sold Marks and Spencer, did Marks and Spencer underperform the benchmark? So there is no other risk adjustment, but intuitively. So coming from London Business School, I can't help but to give you a quiz just now, okay? In an efficient market, the hit rate will be 50%. Yeah? Half the decisions will make money, half will lose money. If you believe in God or some crystal ball, 100% of the decisions will make money. Yeah? You'll always buy the ones which will outperform the benchmark, always sell the ones underperform the benchmark. So I want to ask you to pick a number, an integer between 50 to 100. 50% means no skill, efficient markets. 100% means perfect foresight, perfect skill. So where do you think these creme de la creme managers, recommended by consultants, gone through the beauty contest, et cetera, lie within 50 to 100? 62, okay. We have one group. Anybody else who believes are plus or minus 2% of 62? All right, so there are some here. Ladies, I would like to ask some of the ladies in the audience who have been kind of.
50.
One lady says 50. Some ladies at the back?
I agree with you.
So much herding taking place. We have 62. Don't anybody kind of have any faith in these managers that they can get at least 60% right? It's about 51% of the decisions get right, okay? More typically, I find that in my other classes, ladies are a little more optimistic. They give between 65 to 70%, but maybe not Swiss ones. they know these managers really well. But back in England, they think, no, 65, 70 must be. And then there are some cynical ones who say 45, kind of. So it's about 51% of that, right? But they say, well, it's not a fraction of, this is the difference between equal weighting and size weighting. So we also do large trades make more money than small trades? Okay? And indeed, there is a pattern that, yes, large trades do make small money. So even if it's 50%, large trades make more profit than the get it right more often. And that's partly because of the conviction that they have. Clearly, the stronger the conviction, bigger the position they will put on. The second part, which was that we presented yesterday, and is available from EFA website, is which trading decisions add value, add alpha, outperform benchmark. On the left side is about the purchases. They are the buy decisions. And what is plotted in the red is incremental alpha, or the value added over the benchmark. So in the first month, the buy decisions adds 37 basis points. In the second month is another 18 basis point in addition to the 37. So while going up, that's what it looks like. It's like a logarithmic function. It's increasing but at a decreasing rate. And the value added dies off by between 9 to 12 months. So the buy decision seems to outperform the benchmark for about 9 to 12 months. So they seem like processing medium-term information, which the rest of the market takes time to digest. The sell side, there doesn't seem to be any pattern. So it seems to be they pay attention to their buy decisions, but sell decision is more a rebalancing where they kind of, it's zero or small negative. But their action seems to be on the buy side, which is interesting in its own right. So in the interest of time, I just want to give you some thoughts as to, it's a broad research agenda, so watch this space. For the first time, we are able to analyze managers the way we analyze sports stars, as to exactly what they do. So they can prove skill appears to exist, but difficult to detect using traditional return-based alpha or those kinds of measures. Trade-based estimate of skill, which we derive as a hit rate or the do large-sized trades make more money. It's a more regression-based kind of an approach. Seems to be more persistent than return-based alpha. Okay, so they say past performance is no guarantee for future performance, yes. But instead of past return-based performance, if I were to look at the past hit rate in the recent past or past this skill of logic-based regression, seems to be more persistent than. This is like sports people being in form. They go through good phase of outperformance, and then they go to lean phase, and then they have to kind of, managers also seem to go through similar phases that we find. Their buy decisions seem to add value, not so much the sell, which is kind of breaks even or maybe lose a little. And not covered in this 20 minutes, but we seem to find that the professional managers also suffer from behavioral biases like retail investors or small investors, where they sell their winners too early. So if you look at the ones when they sell, if they had not sold, whether they would have continued to add value. And they seem to hang on to their losers because they don't like to admit that they got things wrong. Yeah? Men don't like to admit that they got things wrong. You need your spouse to tell you that I told you so. And I have a small sample bias of 1, okay? But it's a repeat phenomenon, has happened so many times that I've now been convinced that you just need, in India there's a saying that you need a critic's house should be your neighbor's house. In most of us people, it happens to be within our house itself, but okay. So they have behavioral issues, well-known disposition effect it's called, and we are investigating this more. And this is especially true for trades that are held for a longer time. If they're held in for 1 month to 3 months, it's in their mind, get it right, they cash out profits, get it wrong, they say, am I allowed to say that on this, shit happens, and then they close the position kind of. But as soon as it stays for 12 months, 15 months, 18 months in this, the behavioral biases start coming in about selling winners, buying losers. So that's all I have to say just now. And I'm happy to hand over to the chair.